Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated, our financial results for 1973 were satisfactory, with operating earnings of $11,930,592, producing a return of 17.4% on beginning stockholders' equity. Although operating earnings improved from $11.43 to $12.18 per share, earnings on equity decreased from the 19.8% of 1,972. This decline occurred because the gain in earnings was not commensurate with the increase in shareholders' investment. We had forecast in last year's report that such a decline was likely. Unfortunately, our forecast proved to be correct. Our textile, banking, and most insurance operations had good years, but certain segments of the insurance business turned in poor results. Overall, our insurance business continues to be a most attractive area in which to employ capital. Management's objective is to achieve a return on capital over the long term, which averages somewhat higher than that of American industry generally, while utilizing sound accounting and debt policies. We have achieved this goal in the last few years, and are trying to take those steps which will enable us to maintain this performance in the future. Prospects for 1974 indicate some further decline in rate of return on our enlarged equity base. Textile operations. Textile demand remained unusually strong throughout 1973. Our main problems revolved around shortages of fiber, which complicated operations and resulted in something less than full utilization of loom capacity. Prices of some fibers skyrocketed during the year. Cost of living council regulations prevented the pricing of many finished products at levels of some of our competitors. However, profits were reasonably commensurate with our capital investment, although below those that apparently might have been achieved had we been able to price at market levels. The textile business has been highly cyclical, and price controls may have served to cut down some of the hills while still leaving us with the inevitable valleys. Because of the extraordinary price rises in raw materials during 1973, which show signs of continuing in 1974, we have elected to adopt the LIFO method of inventory pricing. This method more nearly matches current costs against current revenues and minimizes inventory profits included in reported earnings. Further information on this change is included in the footnotes to our financial statements. Insurance operations. During 1973, Jack Ringwalt retired as president of National Indemnity Company after an absolutely brilliant record since founding the business in 1940. He was succeeded by Phil Lesh, who, fortunately for us, possesses the same underwriting and managerial philosophy that worked so well for Jack. Our traditional business, specialized auto and general liability lines conducted through National Indemnity Company and National Fire and Marine Insurance Company, had an exceptionally fine underwriting year during 1973. We again experienced a decline in volume. Competition was intense, and we passed up the chance to match rate cutting by more optimistic underwriters. There currently are faint indications that some of these competitors are learning of the inadequacy of their rates and also of their loss reserves, which may result in easing of market pressures as the year develops. If so, we may again experience volume increases. Our reinsurance operation had a somewhat similar year, good underwriting experience, but difficulty in maintaining previous volume levels. This operation, guided by the tireless and well-directed efforts of George Young, has been a major profit producer since its inception in 1969. Our home state insurance companies made excellent progress in Nebraska and Minnesota, with both good growth in volume and acceptable loss ratios. We began operations late in the year in Iowa. To date, our big problem has been Texas. In that state, we virtually had to start over during 1973, as the initial management we selected proved incapable of underwriting successfully. The Texas experience has been expensive, and we still have our work cut out for us. Overall, however, the home state operation appears to have a promising potential. Our specialized urban auto operation, Home and Automobile Insurance Company, experienced very poor underwriting in Chicago during 1973. It would appear that rates are inadequate in our primary Cook County marketing area, although the current energy situation confuses the picture. The question is whether possible lowered accident frequency because of reduced driving will more than offset continuing inflation in medical and repair costs, as well as jury awards. We believe that inflation will hurt us more than reduced driving will help us, but some of our competitors appear to believe otherwise. Home and Auto expanded into Florida and California during the year, but it is too early to know how these moves will prove out financially. A contributing factor in our unsatisfactory earnings at home and auto during 1973 was an accounting system which was not bringing information to management on a sufficiently timely basis. This situation now is being corrected. On the investment side of our insurance operation, we made substantial additional commitments in common stocks during 1973. We had significant unrealized appreciation over $12 million in our common stock holdings at year-end, as indicated in our financial statements. Nevertheless, we believe that our common stock portfolio at cost represents good value in terms of intrinsic business worth. In spite of the large unrealized loss at year-end, we would expect satisfactory results from the portfolio over the longer term. Banking operations. The Illinois National Bank and Trust Co. of Rockford again had a record year in 1973. Average deposits were approximately $130 million, of which approximately 60% were time deposits. Interest rates were increased substantially in the important consumer savings area when regulatory maximums were raised at mid-year. Despite this mix heavily weighted toward interest-bearing deposits, our operating earnings after taxes, including a new Illinois state income tax, were again over 2.1% of average deposits. We continue to be the largest bank in Rockford. We continue to maintain unusual liquidity. We continue to meet the increasing loan demands of our customers. And we continue to maintain our unusual profitability. This is a direct tribute to the abilities of Gina Begg, chairman, who has been running the bank since it opened its doors in 1931, and Bob Klein, our president. Merger with Diversified Retailing Company, Incorporated. Your directors have approved the merger of Diversified Retailing Company, Incorporated into Berkshire Hathaway, Incorporated, on terms involving issuance of 195,000 shares of Berkshire stock for 1 million shares of Diversified stock outstanding. Because Diversified and its subsidiaries own 109,551 shares of Berkshire, the net increase in the number of shares of Berkshire outstanding after giving effect to this transaction will not exceed 85,449. Various regulatory approvals must be obtained before this merger can be completed, and proxy material will be submitted to you later this year so that you may vote upon it. Diversified Retailing Company, Incorporated, through subsidiaries, operates a chain of popular priced women's apparel stores and also conducts a reinsurance business. In the opinion of your management, its most important asset is 16% of the stock of Blue Chip Stamps. Blue Chip Stamps. Our holdings of stock in Blue Chip Stamps at year-end amounted to approximately 19% of that company's outstanding shares. Since year-end, we have increased our holdings so that they now represent approximately 2%. Implementation of the proposed merger with Diversified Retailing Company, Incorporated, would increase this figure to about 3.81%. Our equity and earnings of Blue Chip Stamps became significant for the first time in 1973, and posed an accounting question as to just what period's earnings should be recognized by Berkshire Hathaway, Incorporated as applicable to the financial statements covered by this annual report. Blue Chip's fiscal year ends on the Saturday closest to February 28, or 2 months after the fiscal year end of Berkshire Hathaway Incorporated. Or, viewed, alternatively, their year ends 10 months prior to Berkshire Hathaway's. An acceptable accounting choice for us, and one which, if made, would not have required an auditor's disclaimer as to scope, was to recognize in our 1973 income and equity of $632,000 in Blue Chip's earnings for their year ended the 3rd of March 1973, with regard to the fewer shares of Blue Chip we owned during this earlier period. But such an approach seemed at odds with reality, and would have meant a 10-month lag each year in the future. Therefore, we chose to reflect as $1,973 income our equity of $1,008,000 in Blue Chip's earnings based upon unaudited interim earnings through November, as publicly reported by Blue Chip Stamps, and with regard to our shareholdings during 1973, because we made this choice of unaudited but current figures, as opposed to the alternative of audited but far from current figures, Pete, Marwick, Mitchell & Co. were unable to express an opinion on our 1,973 earnings attributable to Blue Chip Stamps. The annual report of Blue Chip Stamps, which will contain financial statements for the year ending the 2nd of March 1974 audited by Price Waterhouse & Company, will be available in early May. Any shareholder of Berkshire Hathaway Incorporated who desires an annual report of Blue Chip Stamps may obtain it at that time by writing Mr. Robert H. Bird, Secretary, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California 90040. Blue Chip's trading stamp business has declined drastically over the past year or so, but it has important sources of earning power in its See's Candy Shop subsidiary, as well as Wesco Financial Corporation, a 54% owned subsidiary engaged in the savings and loan business. We expect Blue Chip Stamps to achieve satisfactory earnings in future years related to capital employed, although certainly at a much lower level than would have been achieved if the trading stamp business had been maintained at anything close to former levels. Your chairman is on the board of directors of Blue Chip Stamps, as well as Wesco Financial Corporation, and is chairman of the board of See's Candy Shops Incorporated. Operating management of all three entities is in the hands of first-class, able, experienced executives. Sun Newspapers, Inc. In the 1969 annual report, we commented on the purchase of Sun Newspapers Incorporated, a group of weekly papers published in the metropolitan Omaha area. Since that time, we have not commented on their operations in the text of our annual reports, nor have we consolidated their financial results since the operation, because of the small investment involved, has been financially insignificant. During 1973, it was made quite apparent that such insignificance did not extend to publishing quality. On May 7, Sun Newspapers was awarded a Pulitzer Prize for local investigative reporting, the first time in history that a weekly had won in this category, for its special section of March 30, 1972, relating to Boys Town. We reported the extraordinary contrast between decreasing services and mounting wealth that had taken place since Father Flanagan's death in 1948. In addition to the Pulitzer Prize, the reporting job also won the Public Service Award of Sigma Delta Chi, the National Society of Professional Journalists, as well as 7 other national awards. Our congratulations go to Paul Williams, editor, and Stan Lipsey, publisher, as well as the entire editorial staff of Sun Newspapers for their achievement, which vividly illustrated that size need not be equated with significance in publishing. Warren E. Buffett, chairman of the board. The 29th of March, 1974. Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated, operating results for 1,974 overall were unsatisfactory due to the poor performance of our insurance business. In last year's annual report, some decline in profitability was predicted, but the extent of this decline, which accelerated during the year, was a surprise. Operating earnings for 1974 were $8,383,576, or $8.56 per share, for a return on beginning shareholders' equity of 10.3%. This is the lowest return on equity realized since 1970. Our textile division and our bank both performed very well, turning in improved results against the already good figures of 1,973. However, insurance underwriting, which has been mentioned in the last several annual reports as running at levels of unsustainable profitability, turned dramatically worse as the year progressed. The outlook for 1,975 is not encouraging. We undoubtedly will have sharply negative comparisons in our textile operation, and probably a moderate decline in banking earnings. Insurance underwriting is a large question mark at this time. It certainly won't be a satisfactory year in this area, and could be an extremely poor one. Prospects are reasonably good for an improvement in both insurance investment income and our equity in earnings of Blue Chip Stamps. During this period, we plan to continue to build financial strength and liquidity, preparing for the time when insurance rates become adequate and we can once again aggressively pursue opportunities for growth in this area. Textile operations. During the first 9 months of 1,974, textile demand was exceptionally strong, resulting in very firm prices. However, in the fourth quarter, significant weaknesses began to appear, which have continued into 1,975. We currently are operating at about 1/3 of capacity. Obviously, at such levels, operating losses must result. As shipments have fallen, we continuously have adjusted our level of operations downward so as to avoid building inventory. Our products are largely in the curtain goods area. During a period of consumer uncertainty, curtains may well be high on the list of deferrable purchases. Very low levels of housing starts also serve to dampen demand. In addition, retailers have been pressing to cut inventories generally, and we probably are feeling some effect from these efforts. These negative trends should reverse in due course, and we are attempting to minimize losses until that time comes. Insurance underwriting. In the last few years, we consistently have commented on the unusual profitability in insurance underwriting. This seemed certain eventually to attract unintelligent competition with consequent inadequate rates. It also has been apparent that many insurance organizations, major as well as minor, have been guilty of significant under-reserving of losses, which inevitably produces faulty information as to the true cost of the product being sold. In 1974, these factors, along with a high rate of inflation, combined to produce a rapid erosion in underwriting results. The costs of the product we deliver, aula repair, medical payments, compensation benefits, etc., are increasing at a rate we estimate to be in the area of 1% per month. Of course, this increase doesn't proceed in an even flow, but, inexorably, inflation grinds very heavily at the repair services to humans and to property that we provide. However, rates virtually have been unchanged in the property and casualty field for the last few years. With costs moving forward rapidly and prices remaining unchanged, it was not hard to predict what would happen to profit margins. Bests, the authoritative voice of the insurance industry, estimates that in 1974 all auto insurance premiums in the United States increased only about 2%. Such a growth in the pool of dollars available to pay insured losses and expenses was woefully inadequate. Obviously, medical costs applicable to people injured during the year, jury awards for pain and suffering, and body shop charges for repairing damaged cars increased at a dramatically greater rate during the year. Since premiums represent the sales dollar and the latter items represent the cost of goods sold, profit margins turned sharply negative. As this report is being written, such deterioration continues. Loss reserves for many giant companies still appear to be understated by significant amounts, which means that these competitors continue to underestimate their true costs. Not only must rates be increased sufficiently to match the month-by-month increase in cost levels, but the existing expense-revenue gap must be overcome. At this time, it appears that insurers must experience even more devastating underwriting results before they take appropriate pricing action. All major areas of insurance operations, except for the home state companies, experienced significantly poorer results for the year. The direct business of National Indemnity Company, our largest area of insurance activity, produced an underwriting loss of approximately 4% after several years of high profitability. Volume increased somewhat, but we are not encouraging such increases until rates are more adequate. At some point in the cycle, after major insurance companies have had their fill of redink, history indicates that we will experience an inflow of business at compensatory rates. This operation, headed by Phil Leisha, a most able underwriter, is staffed by highly profit-oriented people, and we believe it will provide excellent earnings in most future years, as it has in the past. Intense competition in the reinsurance business has produced major losses for practically every company operating in the area. We have been no exception. Our underwriting loss was something over 12%, a horrendous figure, but probably little different from the average of the industry. What is even more frightening is that, while about the usual number of insurance catastrophes occurred during 1974, there really was no super disaster which might have accounted for the poor figures of the industry. Rather, a condition of inadequate rates prevails, particularly in the casualty area where we have significant exposure. Our reinsurance department is run by George Young, an exceptionally competent and hardworking manager. He has canceled a great many contracts where prices are totally inadequate and is making no attempt to increase volume except in areas where premiums are commensurate with risk. Based upon present rate levels, it seems highly unlikely that the reinsurance industry generally, or we, specifically, will have a profitable year in 1975. Our home state companies, under the leadership of John Ringwalt, made good progress in 1974. We appear to be developing a sound agency group, capable of producing business with acceptable loss ratios. Our expense ratios still are much too high, but will come down as the operation develops into units of economic size. The Texas problem, which was commented upon in last year's report, seems to be improving. We consider the home state operation one of our more promising areas for the future. Our efforts to expand home and automobile insurance company into Florida proved disastrous. The underwriting loss from operations in that market will come to over $2 million, a very large portion of which was realized in 1974. We made the decision to drop out of the Florida market in the middle of 1974, but losses in substantial amounts have continued since that time because of the term nature of insurance contracts, as well as adverse development on outstanding claims. We can't blame external insurance industry conditions for this mistake. In retrospect, it is apparent that our management simply did not have the underwriting information and the pricing knowledge necessary to be operating in the area. In Cook County, where home and autos volume traditionally has been concentrated, evidence also became quite clear during 1914 that rates were inadequate. Therefore, rates were increased during the middle of the year, but competition did not follow. Consequently, our volume has dropped significantly in this area as competitors take business from us at prices that we regard as totally unrealistic. While the tone of this section is pessimistic as to 1,974 and 1,975, we consider the insurance business to be inherently attractive. Our overall return on capital employed in this area, even including the poor results of 1,974, remains high. We have made every effort to be realistic in the calculation of loss and expense reserves. Many of our competitors are in a substantially weakened financial position, and our strong capital picture leaves us prepared to grow significantly when conditions become right. Insurance investment results. Investment funds generated from the operation of our insurance companies continued to grow during 1,974. Investment income grew correspondingly and produced overall profitability for the insurance group despite the poor underwriting results. As the insurance group balance sheet shows, we have increased liquidity substantially. This trend has continued since year-end. With poor underwriting, and with generally weakened capital ratios throughout the insurance industry, such a higher level of liquidity is appropriate and comforting. It eliminates the possible temptation to write business at any price, simply to maintain cash flow, which is a major problem faced by many companies. Several comments regarding market value of securities may be appropriate. Between the insurance group and the bank, we have approximately $140 million invested in bonds. About $20 million of this investment is in very short-term treasury securities or commercial paper, neither of which is subject to other than negligible market fluctuation. This leaves about $120 million in bonds of longer maturities, with a very large percentage of this sum in municipal bonds with an average maturity of perhaps 12 to 15 years. Because of our large liquid position and inherent operating characteristics of our financial businesses, it is quite unlikely that we will be required to sell any quantity of such bonds under disadvantageous conditions. Rather, it is our expectation that these bonds either will be held to maturity or sold at times believed to be advantageous. However, on any given day, the market value of our bond portfolio is determined by yields available on comparable securities. Such market values can swing dramatically. For example, during 1,974, a leading index of high-grade municipals increased in yield from a level of 5.18% at the beginning of the year to 7.08% at the end of the year. In the bond market, each 1/100 of 1% change in yield is referred to as a basis point, and thus, a change of 1% in interest levels is referred to as 100 basis points. As measured by the index, bond yields increased 190 basis points during 1,974. On a 15-year bond, an increase of 10 basis points translates to about a 1% downward change in market value. On $120 million of such bonds, it is therefore clear that a change of 10 basis points in yields, which easily can happen in one day, changes the market value of our bond portfolio by something over $1 million. Thus, in 1974, our bond portfolio, which probably had a market value roughly approximating its carrying value at the start of the year, had a market value substantially below carrying value at the end of the year. The market value of our bond portfolio will continue to move in both directions in response to changes in the general level of yields, but we do not consider such movements, and the unrealized gains and losses that they produce, to be of great importance as long as adequate liquidity is maintained. Our stock portfolio declined again in 1974, along with most equity portfolios, to the point that at year-end it was worth approximately $17 million less than its carrying value. Again, we are under no pressure to sell such securities except at times that we deem advantageous, and it is our belief that, over a period of years, the overall portfolio will prove to be worth more than its cost. A net capital loss was realized in 1974, and very likely again will occur in 1975. However, we consider several of our major holdings to have great potential for significantly increased values in future years, and therefore feel quite comfortable with our stock portfolio. At this writing, market depreciation of the portfolio has been reduced by more than half from year-end figures. reflecting higher general stock market levels. Banking operations. There is little new to say about Illinois National Bank and Trust. With Eugene Abegg running the operation, the exceptional has become the commonplace. Year after year, he continues to run one of the most profitable banks in the United States, while paying maximum interest rates to depositors, operating with unusual levels of liquidity, maintaining a superior level of loan quality. Two factors specifically should be noted in looking at the separate income statement of the bank. The effect of filing a consolidated tax return is reflected in their figures, with the tax loss of the insurance operations used to offset the tax liability created by banking operations. Also, a property tax formerly paid by the bank now is assessed to the parent company and is reflected in corporate selling and administrative expense. Because of accruals, this had a double effect at both the bank and corporate level in 1974. Under present money market conditions, we expect bank earnings to be down somewhat in 1975, although we believe they still are likely to compare favorably with those of practically any banking institution in the country. Blue chip stamps. During 1974, we increased our holdings of blue chip stamps to approximately 25.5% of the outstanding shares of that company. Overall, we are quite happy about the results of blue chip and its prospects for the future. Stamp sales continue at a greatly reduced level, but the blue chip management has done an excellent job of adjusting operating costs. The See's Candy Shops, Incorporated subsidiary had an outstanding year and has excellent prospects for the future. Your chairman is on the board of directors of Blue Chip Stamps, as well as Wesco Financial Corporation, a 64% owned subsidiary, and is chairman of the board of See's Candy Shops, Incorporated. We expect Blue Chip Stamps to be a source of continued substantial earning power for Berkshire Hathaway Incorporated. The annual report of Blue Chip Stamps, which will contain financial statements for the year ended the 1st of March 1975 audited by Price Waterhouse & Company, will be available in early May. Any shareholder of Berkshire Hathaway Incorporated who desires an annual report of Blue Chip Stamps may obtain it at that time by writing Mr. Robert H. Bird, Secretary, Blue Chip Stamps, 5801, Southeastern Avenue, Los Angeles, California 90040. Merger with Diversified Retailing Company, Incorporated. As you previously have been informed, the proposed merger with Diversified Retailing Company, Incorporated was terminated by the respective boards of directors on the 28th of January 1975. We continue to view such a merger as eventually desirable and hope to reopen the subject at some future time. Warren E. Buffett, Chairman of the Board. The 31st of March, 1975. Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated. Last year, when discussing the prospects for 1975, we stated, the outlook for 1975 is not encouraging. This forecast proved to be distressingly accurate. Our operating earnings for 1975 were $6,713,592, or $6.85 per share, producing a return on beginning shareholders' equity of 7.6%. This is the lowest return on equity experienced since 1967. Furthermore, as explained later in this letter, a large segment of these earnings resulted from federal income tax refunds, which will not be available to assist performance in 1976. On balance, however, current trends indicate a somewhat brighter 1976. Operations and prospects will be discussed in greater detail below, under specific industry titles. Our expectation is that significantly better results in textiles, earnings added from recent acquisitions, an increase in equity in earnings of blue chip stamps resulting from an enlarged ownership interest, and at least a moderate improvement in insurance underwriting results will more than offset other possible negatives to produce greater earnings in 1976. The major variable and by far the most difficult to predict with any feeling of confidence is the insurance underwriting result. Present very tentative indications are that underwriting improvement is in prospect. If such improvement is moderate, our overall gain in earnings in 1976 likewise will prove moderate. More significant underwriting improvement could give us a major gain in earnings. Textile operations. During the first half of 1975, sales of textile products were extremely depressed, resulting in major production curtailments. Operations ran at a significant loss, with employment down as much as 53% from a year earlier. In contrast with previous cyclical slumps, however, most textile producers quickly reduced production to match incoming orders, thus preventing massive industry-wide accumulation of inventories. Such cutbacks caused quite prompt reflection at the mill operating level when demand revived at retail. As a result, beginning about mid-year business rebounded at a fairly rapid rate. This V-shaped textile depression, while one of the sharpest on record, also became one of the shortest ones in our experience. The fourth quarter produced an excellent profit for our textile division, bringing results for the year into the black. On the 28th of April 1975, we acquired Wambeck Mills Incorporated and Wambeck Dyeing and Finishing Co., Incorporated located in Manchester, New Hampshire. These companies have long sold woven goods into the drapery and apparel trade. Such drapery materials complement and extend the lineage already marketed through the Home Fabrics division of Berkshire Hathaway. In the period prior to our acquisition, the company had run at a very substantial loss, with only about 55% of looms in operation and the finishing plant operating at about 50% of capacity. Losses continued on a reduced basis for a few months after acquisition. Outstanding efforts by our manufacturing, administrative and salespeople now have produced major improvements, which, coupled with the general revival in textiles, have moved Wambeck into a significant profit position. We expect a good level of profits from textiles in 1976. Continued progress is being made in the movement of Wambeck goods into areas of traditional marketing strength of Berkshire Hathaway. Productivity should improve in both the weaving and finishing areas at Manchester, and textile demand continues to firm at decent prices. We have great confidence in the ability of Ken Chase and his team to maximize our strengths in textiles. Therefore, we continue to look for ways to increase further our scale of operations while avoiding major capital investment in new fixed assets, which we consider unwise, considering their relatively low returns historically earned on large-scale investment in new textile equipment. Insurance underwriting. The property and casualty insurance industry had its worst year in history during 1975. We did our share, unfortunately, even somewhat more. Really disastrous results were concentrated in auto and long-tail contracts where settlement of loss usually occurs long after the loss event lines. Economic inflation, with the increase in cost of repairing humans and property far outstripping the general rate of inflation, produced ultimate loss costs which soared beyond premium levels established in a different cost environment. Social inflation caused the liability concept to be expanded continuously, far beyond limits contemplated when rates were established in effect, adding coverage beyond what was paid for. Such social inflation increased significantly both the propensity to sue and the possibility of collecting mammoth jury awards for events not previously considered statistically significant in the establishment of rates. Furthermore, losses to policyholders which otherwise would result from mushrooming insolvencies of companies inadequately reacting to these problems are divided through guarantee funds among remaining solvent insurers. These trends will continue and should moderate any optimism which otherwise might be justified by the sharply increased rates now taking effect. Berkshire Hathaway's insurance subsidiaries have a disproportionate concentration of business in precisely the lines which produced the worst underwriting results in 1975. Such lines produce unusually high investment income, and therefore, have been particularly attractive to us under previous underwriting conditions. However, our mix has been very disadvantageous during the past 2 years, and it well may be that we will remain positioned in the more difficult part of the insurance spectrum during the inflationary years ahead. The only segment to show improved results for us during 1975 was the home state operation, which has made continuous progress under the leadership of John Ringwalt. Although still operating at a significant underwriting loss, the combined ratio improved from 1,974. Adjusted for excess costs attributable to operations still in the startup phase, underwriting results are satisfactory. Texas United Insurance Company, a major problem a few years ago, has made outstanding progress since George Billing has assumed command. With an almost totally new agency force, Texas United was the winner of the Chairman's Cup for achievement of the lowest loss ratio among the home state companies. Cornhusker Casualty Company, oldest and largest of the home state companies, continues its outstanding operation with major gains in premium volume and a combined ratio slightly under 100. Substantial premium growth is expected at the home state operation during 1976. The measurement of success, however, will continue to be the achievement of a low combined ratio. Our traditional business at National Indemnity Company, representing well over half of our insurance volume, had an extraordinarily bad underwriting year in 1975. Although rates were increased frequently and significantly, they continually lagged loss experience throughout the year. Several special programs instituted in the early 1970s have caused significant losses, as well as a heavy drain on managerial time and energies. Present indications are that premium volume will show a major increase in 1976, and we hope that underwriting results will improve. Reinsurance suffered the same problems as our direct business during 1975. The same remedial efforts were attempted. Because reinsurance contract settlements lag those of direct business, it well may be that any upturn in results from our direct insurance business will precede those of their insurance segment. At our home and automobile insurance company subsidiary, now writing auto business only in the Cook County area of Illinois, experience continued very bad in 1975, resulting in a management change in October. John Seward was made president at that time, and Hayes energetically and imaginatively implemented a completely revamped underwriting approach. Overall, our insurance operation will produce a substantial gain in premium volume during 1976. Much of this will reflect increased rates rather than more policies. Under normal circumstances, such a gain in volume would be welcome, but our emotions are mixed at present. Underwriting experience should improve, and we expect it to, but our confidence level is not high. While our efforts will be devoted to obtaining a combined ratio below 100, it is unlikely to be attained during 1976. Insurance investments. Gains in investment income were moderate during 1975 because premium volume remained flattened. Underwriting losses reduced funds available for investment. Invested assets, measured at cost at year-end, were close to identical with the level at the beginning of the year. At the end of 1974, the net unrealized loss in the stock section of our portfolio amounted to about $17 million. But we expressed the opinion, nevertheless, that this portfolio overall represented good value at its carrying value of cost. During 1975, a net capital loss of $2,888,000 before tax credits was realized, but our present expectation is that 1976 will be a year of realized capital gain. On the 31st of March 1976, our net unrealized gains applicable to equities amounted to about $15 million. Our equity investments are heavily concentrated in a few companies which are selected based on favorable economic characteristics, competent and honest management, and a purchase price attractive when measured against the yardstick of value to a private owner. When such criteria are maintained, our intention is to hold for a long time. Indeed, our largest equity investment is 467,150 shares of Washington Post B stock with a cost of $10.6 million, which we expect to hold permanently. With this approach, stock market fluctuations are of little importance to us, except as they may provide buying opportunities, but business performance is of major importance. On this score, we have been delighted with progress made by practically all of the companies in which we now have significant investments. We have continued to maintain a strong liquid position in our insurance companies. In last year's annual report, we explained how variations of 0.1% in interest rates result in million-dollar swings in market value of our bonds. We consider such market fluctuation of minor importance as our liquidity and general financial strength make it highly improbable that bonds will have to be sold at times other than those of our choice. Banking. It is difficult to find adjectives to describe the performance of Eugene Abegg, Chief Executive of Illinois National Bank and Trust of Rockford, Illinois, our banking subsidiary. In a year when many banking operations experienced major troubles, Illinois National continued its outstanding record. Against average loans of about $65 million, net loan losses were $24,000, or 4%. Unusually high liquidity is maintained with obligations of the U.S. government and its agencies, all due within 1 year, at year-end amounting to about 75% of demand deposits. Maximum rates of interest are paid on all consumer savings instruments which make up more than half of the deposit base. Yet, despite the maintenance of premier liquidity and the avoidance of stretching for high-yield loans, the Illinois National continues as about the most profitable bank of its size, or larger, the country. In 1975, the 30 largest banks in the United States earned an average of 5% on total assets. The Illinois National earned about 4 times that much. These same 30 largest banks carried down 7% of operating revenues to net income. Without counting any tax benefits from consolidation, Illinois National carried down 27%. Jean Abeg opened the doors of the Illinois National Bank in 1931, with paid-in capital of $250,000. In 1932, its first full year of operation, it earned $8,782. No additional capital has been paid in, and we recommend reading its financial statements on pages 28 to 34 to see what a truly outstanding manager has built in 44 years at the helm. Under the present interest rate structure, it is expected that earnings of the bank will be off somewhat during 1976, but still will remain at a highly satisfactory level. Blue chip stamps. During 1975, our holdings of blue chip stamps remained at 25.5% of that company's outstanding shares. However, early in 1976 our holdings were increased to 31.5%. We expect some increase in our equity in blue chips earnings in 1976 because of this increased ownership. The stamp business continues its precipitous decline, with volume in the year ended February 28,197.6 amounting to only 1/6 that of the peak year ended the 28th of February 1970. Don Copeland, Bill Ramsey have done an extraordinary job of cost-cutting, which has served to moderate operating problems resulting from this evaporation of business. In addition, the acquisition of See's Candies in 1972 has proven a real winner. Chuck Huggins's management has been outstanding, and profits have moved up dramatically during the past several years. Shareholders of Berkshire Hathaway Incorporated desiring the current annual report of blue chip stamps should write Mr. Robert H. Bird, Secretary, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040. Federal income tax implications. In reading our earnings statement, you will notice a significant amount of federal income taxes paid in earlier years are now recoverable because of the net operating loss, as computed for tax purposes, sustained in 1975. Such loss results from the exclusion from income of 100% of interest from state and local issues, and 85% of dividends from domestic corporations. We have exhausted our reservoir of available tax recoveries, and therefore, a repeat of our overall operating performance in 1976 would produce much smaller net earnings. While we do not expect this result, it is important that you are aware of the absence of this cushion in the event that operating losses, as calculated for federal tax purposes, should continue. Acquisition of K&W Products. In addition to the 1,975 Wambeck acquisition, we acquired for cash and notes on the 6th of January 1978. 100% of the assets of K&W Products, including its insurance subsidiaries. The insurance operations are minor in scope, representing business already associated with National Indemnity Company. K&W Products manufactures specialty automotive chemicals for use in automobile maintenance, such as radiator and block sealants, gasket compounds, and fuel and oil additives. The company has extensive trademark or trade name protection for its products, which it manufactures at plants in California and Indiana. Although relatively small, with sales of a little over $2 million, it consistently has generated favorable earnings. Positioned as we now are with respect to income taxes, the addition of a solid source of taxable income is particularly welcome. General review. Your present management assumed responsibility at Berkshire Hathaway in May 1965. At the end of the prior fiscal year, September 1964, the net worth of the company was $22. 1,000,000 and 1,137,778 common shares were outstanding, with a resulting book value of $19.46 per share. 10 years earlier, Berkshire Hathaway's net worth had been $53.4 million. Dividends and stock repurchases accounted for over $21 million of the decline in company net worth, but aggregate net losses of $9.8 million had been incurred on sales of $595 million during the decade. In 1965, 2 New England textile mills were the company's only sources of earning power and, before Ken Chase assumed responsibility for the operation, textile earnings had been erratic and, cumulatively, something less than zero subsequent to the merger of Berkshire Fine Spinning and Hathaway Manufacturing. Since 1964, net worth has been built to $92.9 million, or $94.92 per share. We have acquired total, or virtually total ownership of 6 businesses through negotiated purchases for cash, or cash and notes, from private owners, started 4 others, purchased a 31.5% interest in a large affiliate enterprise, and reduced the number of outstanding shares of Berkshire Hathaway to 979,569. Overall, equity per share has compounded at an annual rate of slightly over 15%. While 1,975 was a major disappointment, efforts will continue to develop growing and diversify sources of earnings. Our objective is a conservatively financed and highly liquid business possessing extra margins of balance sheet strength, consistent with the fiduciary obligations inherent in the banking, insurance industries, which will produce a long-term rate of return on equity capital exceeding that of American industry as a whole. Warren E. Buffett, Chairman, Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated, after 2 dismal years, operating results in 1976 improved significantly. Last year we said the degree of progress in insurance underwriting would determine whether our gain in earnings would be moderate or major. As it turned out, earnings exceeded even the high end of our expectations. In large part, this was due to the outstanding efforts of Phil Leish's managerial group at National Indemnity Company. In dollar terms, operating earnings came to $16,073,000, or $16.47 per share. While this is a record figure, we consider return on shareholders' equity to be a much more significant yardstick of economic performance. Here our result was 17.3%, moderately above our long-term average and even further above the average of American industry, but well below our record level of 19.8% achieved in 1972. Our present estimate, subject to all the caveats implicit in forecasting, is that dollar operating earnings are likely to improve somewhat in 1977, but that return on equity may decline a bit from the 1,976 figure. Textile operations. Our textile division was a significant disappointment during 1976. Earnings, measured either by return on sales or by return on capital employed, were inadequate. In part, this was due to industry conditions which did not measure up to expectations of a year ago. But equally important were our own shortcomings. Marketing efforts and mill capabilities were not properly matched in our new Wambeck operation. Unfavorable manufacturing cost variances were produced by improper evaluation of machinery and personnel capabilities. Ken Chase, as always, has been candid in reporting problems and has worked diligently to correct them. He is a pleasure to work with even under difficult operating conditions. While the first quarter outlook is for red ink, our quite tentative belief is that textile earnings in 1977 will equal or exceed modestly those of 1,976. Despite disappointing current results, we continue to look for ways to build our textile operation, and presently have one moderate-size acquisition under consideration. It should be recognized that the textile business does not offer the expectation of high returns on investment. Nevertheless, we maintain a commitment to this division, a very important source of employment in New Bedford and Manchester, and believe reasonable returns on average are possible. Insurance underwriting. Casualty insurers enjoyed some rebound from the disaster levels of 1,975, as rate increases finally outstripped relentless cost increases. Preliminary figures indicate that the stockholder-owned portion of the property and casualty industry had a combined ratio of 103 inches, 1,976, compared to 108, 3 inches, 1,975. 100 represents a break-even position on underwriting, and higher figures represent underwriting losses. We are unusually concentrated in auto lines where stock companies had an improvement from 113.5 to 107.4. Our own overall improvement was even more dramatic, from 115.4 to 98.7. Our major insurance sector in insurance, the traditional auto and general liability business of National Indemnity Company, had an outstanding year, achieving profit levels significantly better than the industry generally. Credit for this performance must be given to Phil Leish, aided particularly by Roland Miller in underwriting and Bill Lyons in claims. Volume at National Indemnity Company grew rapidly during 1976 as competitors finally reacted to the inadequacy of past rates. But, as mentioned in last year's annual report, we are concentrated heavily in lines that are particularly susceptible to both economic and social inflation. Thus, present rates, which are adequate for today, will not be adequate tomorrow. Our opinion is that before long, perhaps in 1978, the industry will fall behind on rates as temporary prosperity produces unwise competition. If this happens, we must be prepared to meet the next wave of inadequate pricing by a significant reduction in volume. Reinsurance underwriting has lagged the improvement in direct business. When mistakes are made in the pricing of reinsurance, the effects continue for even longer than when similar mistakes are made in direct underwriting. George Young, an outstanding manager, has worked tirelessly to achieve his goal of profitable underwriting, and has cancelled a great many contracts where appropriate rate adjustments were not obtainable. Here, as in the direct business, we have had a concentration in casualty lines which have been particularly hard hit by inflationary conditions. The near-term outlook still is not good for our reinsurance business. Our home state operation continues to make substantial progress under the management of John Ringwalt. The combined ratio improved from 108.4 inches 1,975 to 102.7 inches 1,976. There still are some excess costs reflected in the combined ratio which result from the small size of several operations. Cornhusker Casualty Company, oldest and largest of the home state companies, was the winner of the Chairman's Cup in 1976 for achievement of the lowest loss ratio among the home state companies. Cornhusker also achieved the lowest combined ratio in its history at 94.4, marking the fifth time in its 6 full years of existence that a ratio below 100 has been recorded. Premium growth was 78% at the home state companies in 1976, as market position improved significantly. We presently plan a new home state operation later this year. Our home and automobile insurance company subsidiary, writing primarily automobile business in the Cook County area of Illinois, experienced a strong recovery in 1976. This is directly attributable to John Seward who, in his first full year, has revamped significantly both rating methods and marketing. The auto business has been shifted to a 6-month direct bill policy, which permits a faster reaction time to underwriting trends. Our general liability business at home and automobile has been expanded significantly with good results. While it remains to be proven that we can achieve sustained underwriting profitability at home and auto, we are delighted with the progress John Seward has achieved. Overall, we expect a good year in insurance in 1977. Volume is high, and present rate level should allow profitable underwriting. Longer term, however, there are significant negatives in the insurance picture. Auto lines in particular seem highly vulnerable to pricing and regulatory problems produced by political and social factors beyond the control of individual companies. Insurance investments. Pre-tax investment income in 1976 improved to $10,820,000 from $8,918,000 as invested assets built up substantially, both from better levels of profitability and from gains in premium volume. In recent reports we have noted the unrealized depreciation in our bond account, but stated that we considered such market fluctuations of minor importance, as our liquidity and general financial strength made it improbable that bonds would have to be sold at times other than those of our choice. The bond market rallied substantially in 1976, giving us moderate net unrealized gains at year-end in the bond portfolios of both our bank and insurance companies. This too is of minor importance since our intention is to hold a large portion of our bonds to maturity. The corollary to higher bond prices is that lower earnings are produced by the new funds generated for investment. On balance, we prefer a situation where our bond portfolio has a current market value less than carrying value, but more attractive rates are available on issues purchased with newly generated funds. Last year we stated that we expected 1976 to be a year of realized capital gains, and indeed gains of $9,962,000 before tax, primarily from stocks, were realized during the year. It presently appears that 1977 also will be a year of net realized capital gains. We now have a substantial unrealized gain in our stock portfolio as compared to a substantial unrealized loss several years ago. Here again we consider such market fluctuations from year to year relatively unimportant. Unrealized appreciation in our equity holdings, which amounted to $45.7 million at year-end, has declined by about $5 million, as this is written on March 21st. However, we consider the yearly business progress of the companies in which we own stocks to be very important. And here, we have been delighted by the 1976 business performance achieved by most of our portfolio companies. If the business results continue excellent over a period of years, we are certain eventually to achieve good financial results from our stock holdings, regardless of wide year-to-year fluctuations in market values. Our equity holdings with a market value of over $3 million on the 31st of December 1976 were as follows. You will notice that our major equity holdings are relatively few. We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. 1. Favorable long-term economic characteristics. 2. Competent and honest management. 3. Purchase price attractive when measured against the yardstick of value to a private owner. And 4. An industry with which we are familiar, and whose long-term business characteristics we feel competent to judge. It is difficult to find investments meeting such a test, and that is one reason for our concentration of holdings. We simply can't find 100 different securities that conform to our investment requirements. However, we feel quite comfortable concentrating our holdings in the much smaller number that we do identify as attractive. Our intention usually is to maintain equity positions for a long time, but sometimes we will make a purchase with a shorter expected time horizon, such as Kaiser Industries. Here, a distribution of securities and cash from the parent company is expected to be initiated in 1977. Purchases were made in 1976 after the announcement of the distribution plan by Kaiser Management. Banking. Eugene Abegg, Chief Executive of Illinois National Bank and Trust Company of Rockford, Illinois, our banking subsidiary, continues to lead the parade among bankers just as he has even since he opened the bank in 1931. Recently, National City Corporation of Cleveland, truly an outstandingly well-managed bank, ran an ad stating, the ratio of earnings to average assets was 1.34% in 1976, which we believe to be the best percentage for any major banking company. Among the really large banks, this was the best earnings achievement, but, at the Illinois National Bank, earnings were close to 50% better than those of National City, or approximately 2% of average assets. This outstanding earnings record again was achieved while 1. Paying maximum rates of interest on all consumer savings instruments. Time deposits now make up well over 2/3 of the deposit base at the Illinois National Bank. 2. Maintaining an outstanding liquidity position. Federal funds sold plus U.S. government and agency issues of under 6 months duration presently are approximately equal to demand deposits. And 3. Avoiding high-yield but second-class loans. Net loan losses in 1976 came to about $12,000, or 2% of outstanding loans. A very tiny fraction of the ratio prevailing in 1,976 inches the banking industry. Cost control is an important factor in the bank's success. Employment is still at about the level existing at the time of purchase in 1969, despite growth in consumer time deposits from $30 million to $90 million and considerable expansion in other activities, such as trust, travel, and data processing. Blue chip stamps. During 1976, we increased our interest in blue chip stamps, and by year-end we held about 33% of that company's outstanding shares. Our interest in blue chip stamps is of growing importance at OS. Summary financial reports of blue chip stamps are contained in the footnotes to our attached financial statements. Moreover, shareholders of Berkshire Hathaway Incorporated are urged to obtain the current and subsequent annual reports of blue chip stamps by requesting them from Mr. Robert H. Byrd, Secretary, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040. Miscellaneous. K&W Products has performed well in its first year as a subsidiary of Berkshire Hathaway Inc. Both sales and earnings were up moderately over 1,975. We have less than 4 years remaining to comply with requirement that our bank be divested by December 31, 1980. We intend to accomplish such a divestiture in a manner that minimizes disruption to the bank and produces good results for our shareholders. Most probably this will involve a spin-off of bank shares in 1980. We also hope at some point to merge with Diversified Retailing Company, Incorporated. Both corporate simplification and enhanced ownership position in blue chip stamps would be benefits of such a merger. However, it is unlikely that anything will be proposed in this regard during 1977. Berkshire Hathaway Incorporated. To the stockholders of Berkshire Hathaway Incorporated. Operating earnings in 1977 of $21,904,000, or $22.54 per share, were moderately better than anticipated a year ago. Of these earnings, $1.43 per share resulted from substantial reals capital gains by blue chip stamps, which, to the extent of our proportional interest in that company, are included in our operating earnings figure. Capital gains or losses realized directly by Berkshire Hathaway Incorporated or its insurance subsidiaries are not included in our calculation of operating earnings. While too much attention should not be paid to the figure for any single year, over the longer term the record regarding aggregate capital gains or losses obviously is of significance. Textile operations came in well below forecast, while the results of the Illinois National Bank as well as the operating earnings attributable to our equity interest in Blue Chip Stamps were about as anticipated. However, insurance operations, led again by the truly outstanding results of Philly Esch's managerial group at National Indemnity Company, were even better than our optimistic expectations. Most companies define record earnings as a new high in earnings per share. Since businesses customarily add from year to year to their equity base, we find nothing particularly noteworthy in a management performance combining, say, a 10% increase in equity capital and a 5% increase in earnings per share. After all, even a totally dormant savings account will produce steadily rising interest earnings each year because of compounding. Except for special cases, for example companies with unusual debt-equity ratios or those with important assets carried at unrealistic balance sheet values, we believe a more appropriate measure of managerial economic performance to be return on equity capital. In 1977, our operating earnings on beginning equity capital amounted to 19%. Slightly better than last year and above both our own long-term average and that of American industry in aggregate. But, while our operating earnings per share were up 37% from the year before, our beginning capital was up 24%, making the gain in earnings per share considerably less impressive than it might appear at first glance. We expect difficulty in matching our 1977 rate of return during the forthcoming year. Beginning equity capital is up 23% from a year ago, and we expect the trend of insurance underwriting profit margins to turn down well before the end of the year. Nevertheless, we expect a reasonably good year, and our present estimate, subject to the usual caveats regarding the frailties of forecasts, is that operating earnings will improve somewhat on a per share basis during 1978. Textile operations. The textile business again had a very poor year in 1977. We have mistakenly predicted better results in each of the last 2 years. This may say something about our forecasting abilities, the nature of the textile industry, or both. Despite strenuous efforts, problems in marketing and manufacturing have persisted. Many difficulties experienced in the marketing area are due primarily to industry conditions, but some of the problems have been of our own making. A few shareholders have questioned the wisdom of remaining in the textile business which, over the longer term, is unlikely to produce returns on capital comparable to those available in many other businesses. Our reasons are several. 1. Our mills in both New Bedford and Manchester are among the largest employers in each town, utilizing a labor force of high average age possessing relatively non-transferable skills. Our workers and unions have exhibited unusual understanding and effort in cooperating with management to achieve a cost structure and product mix which might allow us to maintain a viable operation. 2. Management also has been energetic and straightforward in its approach to our textile problems. In particular, Ken Chase's efforts after the change in corporate control took place in 1965 generated capital from the textile division needed to finance the acquisition and expansion of our profitable insurance operation. 3. With hard work and some imagination regarding manufacturing and marketing configurations, it seems reasonable that at least modest profits in the textile division can be achieved in the future. Insurance underwriting. Our insurance operation continued to grow significantly in 1977. It was early in 1967 that we made our entry into this industry through the purchase of National Indemnity Company and National Fire and Marine Insurance Company, sister companies, for approximately $8.6 million. In that year, their premium volume amounted to $22 million. In 1977, our aggregate insurance premium volume was $151 million. No additional shares of Berkshire Hathaway stock have been issued to achieve any of this growth. Rather, this almost 600% increase has been achieved through large gains in National Indemnity's traditional liability areas plus the starting of new companies. Cornhusker Casualty Company in 1970, Lakeland Fire and Casualty Company in 1971, Texas United Insurance Company in 1972, the Insurance Company of Iowa in 1973, and Kansas Fire and Casualty Company in late 1977, the purchase for cash of other insurance companies, Home and Automobile Insurance Company in 1971, Kirkling Reinsurance Corporation, now named Central Fire and Casualty Company, in 1976, and Cyprus Insurance Company at year-end 1977, and finally through the marketing of additional products, most significantly reinsurance, within the National Indemnity Company corporate structure. In aggregate, the insurance business has worked out very well, but it hasn't been a one-way street. Some major mistakes have been made during the decade, both in products and personnel. We experienced significant problems from 1. A surety operation initiated in 1969. 2. The 1973 expansion of Home and Automobile's urban auto marketing into the Miami, Florida area. 3. Unresolved aviation fronting arrangement. And 4. Our workers' compensation operation in California, which we believe retains an interesting potential upon completion of a reorganization now in progress. It is comforting to be in a business where some mistakes can be made, and yet a quite satisfactory overall performance can be achieved. In a sense, this is the opposite case from our textile business, where even very good management probably can average only modest results. One of the lessons your management has learned and, unfortunately, sometimes relearned is the importance of being in businesses where tailwinds prevail rather than headwinds. In 1977, the winds in insurance underwriting were squarely behind us. Very large rate increases were effected throughout the industry in 1976 to offset the disastrous underwriting results of 1974 and 1975. But, because insurance policies typically are written for one-year periods, with pricing mistakes capable of correction only upon renewal, it was 1977 before the full impact was felt upon earnings of those earlier rate increases. The pendulum now is beginning to swing the other way. We estimate that costs involved in the insurance areas in which we operate rise at close to 1% per month. This is due to continuous monetary inflation affecting the cost of repairing humans and property, as well as social inflation, a broadening definition by society and juries of what is covered by insurance policies. Unless rates rise at a comparable 1% per month, underwriting profits must shrink. Recently, the pace of rate increases has slowed dramatically, and it is our expectation that underwriting margins generally will be declining by the second half of the year. We must again give credit to Phil Leashay, greatly assisted by Roland Miller in underwriting and Bill Lyons in claims, for an extraordinary underwriting achievement in National Indemnity's traditional auto and general liability business during 1977. Large volume gains have been accompanied by excellent underwriting margins following contraction or withdrawal by many competitors in the wake of the 1974-75 crisis period. These conditions will reverse before long. In the meantime, National Indemnity's underwriting profitability has increased dramatically, and, in addition, large sums have been made available for investment. As markets loosen and rates become inadequate, we again will face the challenge of philosophically accepting reduced volume. Unusual managerial discipline will be required, as it runs counter to normal institutional behavior to let the other fellow take away business even at foolish prices. Our reinsurance department, managed by George Young, improved its underwriting performance during 1977. Although the combined ratio, see definition on page 12, of 107, was unsatisfactory, its trend was downward throughout the year. In addition, reinsurance generates unusually high funds for investment as a percentage of premium volume. At Home and Auto, John Seward continued to make progress on all fronts. John was a battlefield promotion several years ago, when Home and Auto's underwriting was awash in red ink, and the company faced possible extinction. Under his management, it currently is sound, profitable, and growing. John Ringwalt's home state operation now consists of 5 companies, with Kansas Fire and Casualty Company becoming operational late in 1977 under the direction of Floyd Taylor. The home state companies had net premium volume of $23 million, up from $5.5 million just 3 years ago. All 4 companies that operated throughout the year achieved combined ratios below 100, with Cornhusker Casualty Company at 93.8, the leader. In addition to actively supervising the other 4 home state operations, John Ringwalt manages the operations of Cornhusker, which has recorded combined ratios below 100 inches 6 of its 7 full years of existence, and, from a standing start in 1970, has grown to be one of the leading insurance companies operating in Nebraska, utilizing the conventional independent agency system. Lakeland Fire and Casualty Company, managed by Jim Stodolka, was the winner of the Chairman's Cup in 1977 for achieving the lowest loss ratio among the home state companies. All in all, the home state operation continues to make excellent progress. The newest addition to our insurance group is Cypress Insurance Company of South Pasadena, California. This workers' compensation insurer was purchased for cash in the final days of 1977, and therefore, its approximate $12.5 million of volume for that year was not included in our results. Cypress and National Indemnity's present California workers' compensation operation will not be combined, but will operate independently utilizing somewhat different marketing strategies. Milt Thornton, president of Cypress since 1968, runs a first-class operation for policyholders, agents, employees, and owners alike. We look forward to working with him. Insurance companies offer standardized policies which can be copied by anyone. Their own products are promises. It is not difficult to be licensed, and rates are an open book. There are no important advantages from trademarks, patents, location, corporate longevity, raw material sources, etc., and very little consumer differentiation to produce insulation from competition. It is commonplace, in corporate annual reports, to stress the difference that people make. Sometimes this is true, and sometimes it isn't. But there is no question that the nature of the insurance business magnifies the effect which individual managers have on company performance. We are very fortunate to have the group of managers that are associated with us. Insurance investments. During the past 2 years, insurance investments at cost, excluding the investment in our affiliate, Blue Chip Stamps have grown from $134.6 million to $252.8 million. Growth in insurance reserves, produced by our large gain in premium volume, plus retained earnings, have accounted for this increase in marketable securities. In turn, net investment income of the insurance group has improved from $8.4 million pre-tax in 1975 to $12.3 million pre-tax in 1977. In addition to this income from dividends and interest, we realized capital gains of $6.9 million before tax, about 1/4 from bonds and the balance from stocks. Our unrealized gain in stocks at year-end 1977 was approximately $74 million, but this figure, like any other figure of a single date, we had an unrealized loss of $17 million at the end of 1974, should not be taken too seriously. Most of our large stock positions are going to be held for many years, and the scorecard in our investment decisions will be provided by business results over that period, and not by prices on any given day. Just as it would be foolish to focus unduly on short-term prospects when acquiring an entire company, we think it equally unsound to become mesmerized by prospective and near-term earnings or recent trends in earnings when purchasing small pieces of a company, that is to say, marketable common stocks. A little digression illustrating this point may be interesting. Berkshire Fine Spinning Associates and Hathaway Manufacturing were merged in 1955 to form Berkshire Hathaway Incorporated. In 1948, on a pro forma combined basis, they had earnings after tax of almost $18 million and employed 1,000 people at a dozen large mills throughout New England. In the business world of that period, they were an economic powerhouse. For example, in that same year, earnings of IBM were $28 million, now $2.7 billion, Safeway Stores, $10 million, Minnesota Mining, $13 million, and Time Incorporated, $9 million. But, in the decade following the 1955 merger, aggregate sales of $595 million produced an aggregate loss for Berkshire Hathaway of $10 million. By 1964, the operation had been reduced to 2 mills, and net worth had shrunk to $22 million, from $53 million at the time of the merger. So much for single-year snapshots as adequate portrayals of a business. Equity holdings of our insurance companies with a market value of over $5 million on December 31, 1977 were as follows. We select our marketable equity securities in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be 1. One that we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Available at a very attractive price. We ordinarily make no attempt to buy equities for anticipated favorable stock price behavior in the short term. In fact, if their business experience continues to satisfy us, we welcome lower market prices of stocks we own as an opportunity to acquire even more of a good thing at a better price. Our experience has been that pro rata portions of truly outstanding businesses sometimes sell in the securities markets at very large discounts from the prices they would command in negotiated transactions involving entire companies. Consequently, bargains in business ownership, which simply are not available directly through corporate acquisition, can be obtained indirectly through stock ownership. When prices are appropriate, we are willing to take very large positions in selected companies, not with any intention of taking control and not foreseeing sellout or merger, but with the expectation that excellent business results by corporations will translate over the long term into correspondingly excellent market value and dividend results for owners, minority as well as majority. Such investments initially may have negligible impact on our operating earnings. For example, we invested $10.9 million in Capital Cities Communications during 1977. Earnings attributable to the shares we purchased totaled about $1.3 million last year. But only the cash dividend, which currently provides $40,000 annually, is reflected in our operating earnings figure. Capital Cities possesses both extraordinary properties and extraordinary management, and these management skills extend equally to operations and employment of corporate capital. To purchase, directly, properties such as Capital Cities owns would cost in the area of twice our cost of purchase via the stock market, and direct ownership would offer no important advantages to us. While control would give us the opportunity and the responsibility to manage operations and corporate resources, we would not be able to provide management in either of those respects equal to that now in place. In effect, we can obtain a better management result through non-control than control. This is an unorthodox view, but one we believe to be sound. Banking. In 1977, the Illinois National Bank continued to achieve a rate of earnings on assets about 3 times that of most large banks. As usual, this record was achieved while the bank paid maximum rates to savers and maintained an asset position combining low risk and exceptional liquidity. Jean Abegg formed the bank in 1931 with $250,000. In its first full year of operation, earnings amounted to $8,782. Since that time, no new capital has been contributed to the bank. On the contrary, since our purchase in 1969, dividends of $20 million have been paid. Earnings in 1977 amounted to $3.6 million, more than achieved by many banks 2 or 3 times its size. Late last year, Jean, now 80 and still running a banking operation without peer, asked that a successor be brought in. Accordingly, Peter Jeffrey, formerly President and Chief Executive Officer of American National Bank of Omaha, has joined the Illinois National Bank effective March 1st as President and Chief Executive Officer. Jean continues in good health as Chairman. We expect a continued successful operation at Rockford's leading bank. Blue Chip Stamps. We again increased our equity interest in Blue Chip Stamps, and owned approximately 36.5% at the end of 1977. Blue Chip had a fine year, earning approximately $12.9 million from operations and, in addition, had realized securities gains of $4.1 million. Both Wesco Financial Corp., an 80% owned subsidiary of Blue Chip Stamps, managed by Louis Vincenti, and See's Candies, a 99% owned subsidiary, managed by Chuck Huggins, made good progress in 1977. Since See's was purchased by Blue Chip Stamps at the beginning of 1972, pre-tax operating earnings have grown from $4.2 million to $12.6 million, with little additional capital investment. See's achieved this record while operating in an industry experiencing practically now-net growth. Shareholders of Berkshire Hathaway Incorporated may obtain the annual report of Blue Chip Stamps by requesting it from Mr. Robert H. Bird, Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California 90040. Warren E. Buffett, Chairman. March 14197-8. Berkshire Hathaway Incorporated. To the shareholders of Berkshire Hathaway Incorporated. First, a few words about accounting. The merger with Diversified Retailing Company, Incorporated, at year-end adds 2 new complications in the presentation of our financial results. After the merger, our ownership of Blue Chip Stamps increased to approximately 58%, and therefore, the accounts of that company must be fully consolidated in the balance sheet and statement of earnings. Presentation of Berkshire. In previous reports, our share of the net earnings only of Blue Chip had been included as a single item on Berkshire's statement of earnings, and there had been a similar one-line inclusion on our balance sheet of our share of their net assets. This full consolidation of sales, expenses, receivables, inventories, debt, etc., produces an aggregation of figures from many diverse businesses: textiles, insurance, candy, newspapers, trading stamps with dramatically different economic characteristics. In some of these your ownership is 100%, but, in those businesses which are owned by Blue Chip but fully consolidated, your ownership as a Berkshire shareholder is only 58%. Ownership by others of the balance of these businesses is accounted for by the large minority interest item on the liability side of the balance sheet. Such a grouping of balance sheet and earnings items, some wholly owned, some partly owned, tends to obscure economic reality more than illuminate it. In fact, it represents a form of presentation that we never prepare for internal use during the year, and which is of no value to us in any management activities. For that reason, throughout the report we provide much separate financial information and commentary on the various segments of the business to help you evaluate Berkshire's performance and prospects. Much of this segmented information is mandated by SEC disclosure rules and covered in Management's Discussion on pages 29 to 34. And in this letter, we try to present to you a view of our various operating entities from the same perspective that we view them managerially. A second complication arising from the merger is that the 1,977 figures shown in this report are different from the 1,977 figures shown in the report we mailed to you last year. Accounting convention requires that when two entities such as Diversified and Berkshire are merged, all financial data subsequently must be presented as if the companies had been merged at the time they were formed, rather than just recently. So the enclosed financial statements, in effect, pretend that in 1977 and earlier years the Diversified Berkshire merger already had taken place, even though the actual merger date was December 30, 1978. This shifting base makes comparative commentary confusing, and, from time to time in our narrative report, we will talk of figures and performance for Berkshire shareholders as historically reported to you, rather than as restated after the Diversified merger. With that preamble, it can be stated that, with or without restated figures, 1978 was a good year. Operating earnings, exclusive of capital gains, at 19.4% of beginning shareholders' investment, were within a fraction of our 1972 record. While we believe it is improper to include capital gains or losses in evaluating the performance of a single year, they are an important component of the longer-term record. Because of such gains, Berkshire's long-term growth in equity per share has been greater than would be indicated by compounding the returns from operating earnings that we have reported annually. For example, over the last 3 years generally, a bonanza period for the insurance industry, our largest profit producer Berkshire's per-share net worth virtually has doubled, thereby compounding it about 25% annually through a combination of good operating earnings and fairly substantial capital gains. Neither this 25% equity gain from all sources, nor the 19.4% equity gain from operating earnings in 1978 is sustainable. The insurance cycle has turned downward in 1979, and it is almost certain that operating earnings measured by return on equity will fall this year. However, operating earnings measured in dollars are likely to increase on the much larger shareholders' equity now employed in the business. In contrast to this cautious view about near-term return from operations, we are optimistic about prospects for long-term return from major equity investments held by our insurance companies. We make no attempt to predict how security markets will behave. Successfully forecasting short-term stock price movements is something we think neither we nor anyone else can do. In the longer run, however, we feel that many of our major equity holdings are going to be worth considerably more money than we paid, and that investment gains will add significantly to the operating returns of the insurance group. Sources of earnings. To give you a better picture of just where Berkshire's earnings are produced, we show below a table which requires a little explanation. Berkshire owns close to 58% of Blue Chip, which, in addition to 100% ownership of several businesses, owns 80% of Wesco Financial Corporation. Thus, Berkshire's equity in Wesco's earnings is about 46%. In aggregate, businesses that we control have about 7,000 full-time employees and generate revenues of over $500 million. The table shows the overall earnings of each major operating category on a pre-tax basis. Several of the businesses have low tax rates because of significant amounts of tax-exempt interest and dividend income, as well as the share of those earnings belonging to Berkshire both on a pre-tax and after-tax basis. Significant capital gains or losses attributable to any of the businesses are not shown in the operating earnings figure, but are aggregated on the realized securities gain line at the bottom of the table. Because of various accounting and tax intricacies, the figures in the table should not be treated as holy writ, but rather viewed as close approximations of the 1977 and 1978 earnings contributions of our constituent businesses. Earnings, before income taxes, in thousands of dollars. Blue Chip and Wesco are public companies with reporting requirements of their own. Later in this report, we are reproducing the narrative reports of the principal executives of both companies, describing their 1978 operations. Some of the figures they utilize will not match to the pennytheons we use in this report, again because of accounting and tax complexities. But their comment should be helpful to you in understanding the underlying economic characteristics of these important partly owned businesses. A copy of the full annual report of either company will be mailed to any shareholder of Berkshire, upon request to Mr. Robert H. Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs. Bette Deckard for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California 91109. Textiles. Earnings of $1.3 million in 1978, while much improved from $1,977, still represent a low return on the $17 million of capital employed in this business. Textile plant and equipment are on the books for a very small fraction of what it would cost to replace such equipment today. And, despite the age of the equipment, much of it is functionally similar to new equipment being installed by the industry. But despite this bargain cost of fixed assets, capital turnover is relatively low, reflecting required high investment levels in receivables and inventory compared to sales. Slow capital turnover, coupled with low profit margins on sales, inevitably produces inadequate returns on capital. Obvious approaches to improved profit margins involve differentiation of product, lowered manufacturing costs through more efficient equipment or better utilization of people, redirection toward fabrics enjoying stronger market trends, etc. Our management is diligent in pursuing such objectives. The problem, of course, is that our competitors are just as diligently doing the same thing. The textile industry illustrates in textbook style how producers of relatively undifferentiated goods in capital-intensive businesses must earn inadequate returns except under conditions of tight supply or real shortage. As long as excess productive capacity exists, prices tend to reflect direct operating costs rather than capital employed. Such a supply excess condition appears likely to prevail most of the time in the textile industry, and our expectations are for profits of relatively modest amounts in relation to capital. We hope we don't get into too many more businesses with such tough economic characteristics. But, as we have stated before, 1. Our textile businesses are very important employers in their communities. 2. Management has been straightforward in reporting on problems and energetic in attacking them. 3. Labor has been cooperative and understanding in facing our common problems. And 4. The business should average modest cash returns relative to investment. As long as these conditions prevail, and we expect that they will, we intend to continue to support our textile business despite more attractive alternative uses for capital. Insurance underwriting. The number one contributor to Berkshire's overall excellent results in 1978 was the segment of National Indemnity Company's insurance operation run by Phil Leisha. On about $90 million of earned premiums, an underwriting profit of approximately $11 million was realized. A true extraordinary achievement even against the background of excellent industry conditions. Under Phil's leadership, with outstanding assistance by Roland Miller in underwriting and Bill Lyons in claims, this segment of National Indemnity, including National Fire and Marine Insurance Company, which operates as a running mate, had one of its best years in a long history of performances, which, in aggregate, far outshine those of the industry. Present successes reflect credit not only upon present managers, but equally upon the business talents of Jack Ringwalt, founder of National Indemnity, whose operating philosophy remains etched upon the company. Home and Automobile Insurance Company had its best year since John Seward stepped in and straightened things out in 1975. Its results are combined in this report with those of Filiesh's operation under the insurance category entitled Specialized Auto and General Liability. Workers' compensation was a mixed bag in 1978. In its first year as a subsidiary, Cypress Insurance Company, managed by Milt Thornton, turned in outstanding results. The workers' compensation line can cause large underwriting losses when rapid inflation interacts with changing social concepts. But Milt has a cautious and highly professional staff to cope with these problems. His performance in 1978 has reinforced our very good feelings about this purchase. Frank DiNardo came with us in the spring of 1978 to straighten out National Indemnity's California workers' compensation business, which, up to that point, had been a disaster. Frank has the experience and intellect needed to correct the major problems of the Los Angeles office. Our volume in this department now is running only about 25% of what it was 18 months ago, and early indications are that Frank is making good progress. George Young's reinsurance department continues to produce very large sums for investment relative to premium volume, and thus gives us reasonably satisfactory overall results. However, underwriting results still are not what they should be and can be. It is very easy to fool yourself regarding underwriting results in reinsurance, particularly in casualty lines involving long delays in settlement. And we believe this situation prevails with many of our competitors. Unfortunately, self-delusion in company reserving almost always leads to inadequate industry rate levels. If major factors in the market don't know their true costs, the competitive fallout hits all, even those with adequate cost knowledge. George is quite willing to reduce volume significantly if needed to achieve satisfactory underwriting, and we have a great deal of confidence in the long-term soundness of this business under his direction. The home state operation was disappointing in 1978. Our unsatisfactory underwriting, even though partially explained by an unusual incidence of Midwestern storms, is particularly worrisome against the backdrop of very favorable industry results in the conventional lines written by our home state group. We have confidence in John Ringwald's ability to correct the situation. The bright spot in the group was the performance of Kansas Fire and Casualty in its first full year of business. Under Floyd Taylor, this subsidiary got off to a truly remarkable start. Of course, it takes at least several years to evaluate underwriting results, but the early signs are encouraging, and Floyd's operation achieved the best loss ratio among the home state companies in 1978. Although some segments were disappointing, overall our insurance operation had an excellent year. But of course we should expect a good year when the industry is flying high, as in 1978. It is a virtual certainty that in 1979 the combined ratio, see definition on page 31, for the industry will move up at least a few points, perhaps enough to throw the industry as a whole into an underwriting loss position. For example, in the auto lines, by far the most important area for the industry and for us, CPI figures indicate rates overall were only 3% higher in January 1979 than a year ago. But the items that make up loss costs, auto repair and medical care costs, were up over 9%. How different than year-end 1976, when rates had advanced over 22% in the preceding 12 months. But costs were up 8%. Margins will remain steady only if rates rise as fast as costs. This assuredly will not be the case in 1979, and conditions probably will worsen in 1980. Our present thinking is that our underwriting performance relative to the industry will improve somewhat in 1979, but every other insurance management probably views its relative prospects with similar optimism. Someone is going to be disappointed. Even if we do improve relative to others, we may well have a higher combined ratio and lower underwriting profits in 1979 than we achieved last year. We continue to look for ways to expand our insurance operation, but your reaction to this intent should not be unrestrained joy. Some of our expansion efforts, largely initiated by your chairman, have been lackluster. Others have been expensive failures. We entered the business in 1967 through purchase of the segment which Filiesha now manages, and it still remains, by a large margin, the best portion of our insurance business. It is not easy to buy a good insurance business, but our experience has been that it is easier to buy one than create one. However, we will continue to try both approaches, since the rewards for success in this field can be exceptional. Insurance investments. We confess considerable optimism regarding our insurance equity investments. Of course, our enthusiasm for stocks is not unconditional. Under some circumstances, common stock investments by insurers make very little sense. We get excited enough to commit a big percentage of insurance company net worth to equities only when we find 1. Businesses we can understand, 2. With favorable long-term prospects, 3. Operated by honest and competent people, and 4. Priced very attractively. We usually can identify a small number of potential investments meeting requirements 1, 2, and 3, but 4 often prevents action. For example, in 1971, our total common stock position at Berkshire's insurance subsidiaries amounted to only $10.7 million at cost and $11.7 million at market. There were equities of identifiably excellent companies available, but very few at interesting prices. An irresistible footnote. In 1970, pension fund managers invested a record 122% of net funds available in equities at full prices. They couldn't buy enough of them. In 1974, after the bottom had fallen out, they committed a then record low of 21% to stocks. The past few years have been a different story for us. At the end of 1975, our insurance subsidiaries held common equities with a market value exactly equal to cost of $39.3 million. At the end of 1978, this position had been increased to equities, including a convertible preferred, with a cost of $129.1 million and a market value of $216.5 million. During the intervening 3 years, we also had realized pre-tax gains from common equities of approximately $24.7 million. Therefore, our overall unrealized and realized pre-tax gains in equities for the 3-year period came to approximately $112 million. During this same interval, the Dow Jones Industrial Average declined from 852 to 805. It was a marvelous period for the value-oriented equity buyer. We continue to find for our insurance portfolios small portions of really outstanding businesses that are available, through the auction pricing mechanism of security markets, at prices dramatically cheaper than the valuations inferior businesses command on negotiated sales. This program of acquisition of small fractions of businesses, common stocks, at bargain prices, for which little enthusiasm exists, contrasts sharply with general corporate acquisition activity, for which much enthusiasm exists. It seems quite clear to us that either corporations are making very significant mistakes in purchasing entire businesses at prices prevailing in negotiated transactions and takeover bids, or that we, eventually, are going to make considerable sums of money buying small portions of such businesses at the greatly discounted valuations prevailing in the stock market. A second footnote. In 1978, pension managers, a group that logically should maintain the longest of investment perspectives, put only 9% of net available funds into equities, breaking their record low figure set in 1974 and tied in 1977. We are not concerned with whether the market quickly revalues upward securities that we believe are selling at bargain prices. In fact, we prefer just the opposite, since, in most years, we expect to have funds available to be a net buyer of securities. And consistent attractive purchasing is likely to prove to be of more eventual benefit to us than any selling opportunities provided by a short-term run-up in stock prices, to levels at which we are unwilling to continue buying. Our policy is to concentrate holdings. We try to avoid buying a little of this or that when we are only lukewarm about the business or its price. When we are convinced as to attractiveness, we believe in buying worthwhile amounts. Equity holdings of our insurance companies with a market value of over $8 million on December 31, 1978 were as follows. In some cases, our indirect interest in earning power is becoming quite substantial. For example, note our holdings of 953,750 shares of Safeco Corp. Safeco probably is the best-run large property and casualty insurance company in the United States. Their underwriting abilities are simply superb, their loss reserving is conservative, and their investment policies make great sense. Safeco is a much better insurance operation than our own, although we believe certain segments of ours are much better than average, is better than one we could develop, and similarly, is far better than any in which we might negotiate purchase of a controlling interest. Yet our purchase of Safeco was made at substantially under book value. We paid less than 100 cents on the dollar for the best company in the business, when far more than 100 cents on the dollar is being paid for mediocre companies in corporate transactions. And there is no way to start a new operation with necessarily uncertain prospects at less than 100 cents on the dollar. Of course, with a minor interest, we do not have the right to direct or even influence management policies of Safeco, But why should we wish to do this? The record would indicate that they do a better job of managing their operations than we could do ourselves. While there may be less excitement and prestige in sitting back and letting others do the work, we think that is all one loses by accepting a passive participation in excellent management. Because, quite clearly, if one controlled a company run as well as Safeco, the proper policy also would be to sit back and let management do its job. Earnings attributable to the shares of Safeco owned by Berkshire at year-end amounted to $6.1 million during 1978, but only the dividends received, about 18% of earnings, are reflected in our operating earnings. We believe the balance, although not reportable, to be just as real in terms of eventual benefit to us as the amount distributed. In fact, Safeco's retained earnings, or those of other well-run companies if they have opportunities to employ additional capital advantageously, may well eventually have a value to shareholders greater than 100 cents on the dollar. We are not at all unhappy when our wholly owned businesses retain all of their earnings if they can utilize internally those funds at attractive rates. Why should we feel differently about retention of earnings by companies in which we hold small equity interests, but where the record indicates even better prospects for profitable employment of capital? This proposition cuts the other way, of course, in industries with low capital requirements, or if management has a record of plowing capital into projects of low profitability, then earnings should be paid out or used to purchase shares, often by far the most attractive option for capital utilization. The aggregate level of such retained earnings attributable to our equity interests in fine companies is becoming quite substantial. It does not enter into our reported operating earnings, but we feel it well may have equal long-term significance to our shareholders. Our hope is that conditions continue to prevail in securities markets, which allow our insurance companies to buy large amounts of underlying earning power for relatively modest outlays. At some point, market conditions undoubtedly will again preclude such bargain buying, but, in the meantime, we will try to make the most of opportunities. Banking. Under Gene Abegg and Pete Jeffrey, the Illinois National Bank and Trust Company in Rockford continues to establish new records. Last year's earnings amounted to approximately 2.1% of average assets, about 3 times the level averaged by major banks. In our opinion, this extraordinary level of earnings is being achieved while maintaining significantly less asset risk than prevails at most of the larger banks. We purchased the Illinois National Bank in March 1969. It was a first-class operation then, just as it had been ever since Gene Abegg opened the doors in 1931. Since 1968, consumer time deposits have quadrupled, net income has tripled, and trust department income has more than doubled, while costs have been closely controlled. Our experience has been that the manager of an already high-cost operation frequently is uncommonly resourceful in finding new ways to add to overhead, while the manager of a tightly run operation usually continues to find additional methods to curtail costs, even when his costs are already well below those of his competitors. No one has demonstrated this latter ability better than Gene Abegg. We are required to divest our bank by the 31st of December 1980. The most likely approach is to spin it off to Berkshire shareholders sometime in the second half of 1980. Retailing. Upon merging with Diversified, we acquired 100% ownership of Associated Retail Stores, Incorporated, a chain of about 75 popular-priced women's apparel stores. Associated was launched in Chicago on the 7th of March 1931, with 1 store, $3,200, and 2 extraordinary partners, Ben Rosner and Leo Simon. After Mr. Simon's death, the business was offered to Diversified for cash in 1967. Ben was to continue running the business and run it. He has. Associated's business has not grown, and it consistently has faced adverse demographic and retailing trends. But Ben's combination of merchandising, real estate and cost containment skills has produced an outstanding record of profitability, with returns on capital necessarily employed in the business often in the 20% after-tax area. Ben is now 75, and, like Gene Abegg, 81, at Illinois National and Louis Vincenti, 73, at Wesco, continues daily to bring an almost passionately proprietary attitude to the business. This group of top managers must appear to an outsider to be an overreaction on our part to an OEO bulletin on age discrimination. While unorthodox, these relationships have been exceptionally rewarding, both financially and personally. It is a real pleasure to work with managers who enjoy coming to work each morning and, once there, instinctively and unerringly think like owners. We are associated with some of the very best. Warren E. Buffett, Chairman. The 26th of March, 1979. Berkshire Hathaway Incorporated. To the shareholders of Berkshire Hathaway Incorporated. Again, we must lead off with a few words about accounting. Since our last annual report, the accounting profession has decided that equity securities owned by insurance companies must be carried on the balance sheet at market value. We previously have carried such equity securities at the lower of aggregate cost or aggregate market value. Because we have large unrealized gains in our insurance equity holdings, the result of this new policy is to increase substantially both the 1978 and 1979 year in net worth, even after the appropriate liability is established for taxes on capital gains that would be payable should equities be sold at such market valuations. As you know, Blue Chip Stamps, our 60% owned subsidiary, is fully consolidated in Berkshire Hathaway's financial statements. However, Blue Chip still is required to carry its equity investments at the lower of aggregate cost or aggregate market value, just as Berkshire Hathaway's insurance subsidiaries did prior to this year. Should the same equities be purchased at an identical price by an insurance subsidiary of Berkshire Hathaway and by Blue Chip Stamps, present accounting principles often would require that they end up carried on our consolidated balance sheet at two different values. That should keep you on your toes. Market values of Blue Chip Stamps' equity holdings are given in footnote 3 on page 18. 1979 operating results. We continue to feel that the ratio of operating earnings, before securities gains or losses, to shareholders' equity with all securities valued at cost, is the most appropriate way to measure any single year's operating performance. Measuring such results against shareholders' equity with securities valued at market could significantly distort the operating performance percentage because of wide year-to-year market value changes in the net worth figure that serves as the denominator. For example, a large decline in securities values could result in a very low market value net worth that, in turn, could cause mediocre operating earnings to look unrealistically good. Alternatively, the more successful the equity investments have been, the larger the net worth base becomes, and the poorer the operating performance figure appears. Therefore, we will continue to report operating performance measured against beginning net worth, with securities valued at cost. On this basis, we had a reasonably good operating performance in 1979, but not quite as good as that of 1978, with operating earnings amounting to 18.6% of beginning net worth. Earnings per share, of course, increased somewhat, about 20%, but we regard this as an improper figure upon which to focus. We had substantially more capital to work with in 1979 than in 1978, and our performance in utilizing that capital fell short of the earlier year, even though per share earnings rose. Earnings per share will rise constantly on a dormant savings account or on a U.S. savings bond bearing a fixed rate of return simply because earnings, the stated interest rate, are continuously plowed back and added to the capital base. Thus, even a stopped clock can look like a growth stock if the dividend payout ratio is low. The primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, without undue leverage, accounting gimmickry, etc., and not the achievement of consistent gains in earnings per share. In our view, many businesses would be better understood by their shareholder owners, as well as the general public, if managements and financial analysts modified the primary emphasis they place upon earnings per share, and upon yearly changes in that figure. Long-term results. In measuring long-term economic performance, in contrast to yearly performance, we believe it is appropriate to recognize fully any realized capital gains or losses as well as extraordinary items, and also to utilize financial statements presenting equity securities at market value. Such capital gains or losses, either realized or unrealized, are fully as important to shareholders over a period of years as earnings realized in a more routine manner through operations. It is just that their impact is often extremely capricious in the short run, a characteristic that makes them inappropriate as an indicator of single-year managerial performance. The book value per share of Berkshire Hathaway on the 30th of September 1964, the fiscal year and prior to the time that your present management assumed responsibility, was $19.46 per share. At year-end 1979, book value with equity holdings carried at market value was $335.85 per share. The gain in book value comes to 20.5% compounded annually. This figure, of course, is far higher than any average of our yearly operating earnings calculations, and reflects the importance of capital appreciation of insurance equity investments in determining the overall results for our shareholders. It probably also is fair to say that the quoted book value in 1964 somewhat overstated the intrinsic value of the enterprise, since the assets owned at that time on either a going concern basis or liquidating value basis were not worth 100 cents on the dollar. The liabilities were solid, however. We have achieved this result while utilizing a low amount of leverage, both financial leverage measured by debt to equity and operating leverage measured by premium volume to capital funds of our insurance business, and also without significant issuance or repurchase of shares. Basically, we have worked with the capital with which we started. From our textile base, we, or Blue Chip and Wesco subsidiaries, have acquired total ownership of 13 businesses through negotiated purchases from private owners for cash, and have started 6 others. It's worth a mention that those who have sold to us have, almost without exception, treated us with exceptional honor and fairness, both at the time of sale and subsequently. But before we drown in a sea of self-congratulation, a further and crucial observation must be made. A few years ago, a business whose per-share net worth compounded at 20% annually would have guaranteed its owners a highly successful real investment return. Now such an outcome seems less certain. For the inflation rate, coupled with individual tax rates, will be the ultimate determinant as to whether our internal operating performance produces successful investment results. That is to say, a reasonable gain in purchasing power from funds committed for U.S. shareholders. Just as the original 3% savings bond, a 5% passbook savings account, or an 8% U.S. Treasury note have in turn been transformed by inflation into financial instruments that chew up, rather than enhance, purchasing power over their investment lives. A business earning 20% on capital can produce a negative real return for its owners under inflationary conditions, not much more severe than presently prevail. If we should continue to achieve a 20% compounded gain, not an easy or certain result by any means, and this gain is translated into a corresponding increase in the market value of Berkshire Hathaway stock as it has been over the last 15 years, your after-tax purchasing power gain is likely to be very close to zero at a 14% inflation rate. Most of the remaining 6 percentage points will go for income tax anytime you wish to convert your 20 percentage points of nominal annual gain into cash. That combination, the inflation rate, plus the percentage of capital that must be paid by the owner, to transfer into his own pocket the annual earnings achieved by the business, that is to say, ordinary income tax on dividends and capital gains tax on retained earnings, can be thought of as an investor's misery index. When this index exceeds the rate of return earned on equity by the business, the investor's purchasing power, real capital, shrinks even though he consumes nothing at all. We have no corporate solution to this problem. High inflation rates will not help us earn higher rates of return on equity. One friendly but sharp-eyed commentator on Berkshire has pointed out that our book value at the end of 1964 would have bought about 1/2 ounce of gold, and, 15 years later, after we have plowed back all earnings along with much blood, sweat and tears, the book value produced will buy about the same 1/2 ounce. A similar comparison could be drawn with Middle Eastern oil. The rub has been that government has been exceptionally able in printing money and creating promises, but is unable to print gold or create oil. We intend to continue to do as well as we can in managing the internal affairs of the business, but you should understand that external conditions affecting the stability of currency may very well be the most important factor in determining whether there are any real rewards from your investment in Berkshire Hathaway. Sources of earnings. We again present a table showing the sources of Berkshire's earnings. As explained last year, Berkshire owns about 60% of Blue Chip Stamps, which, in turn, owns 80% of Wesco Financial Corporation. The table shows both aggregate earnings of the various business entities, as well as Berkshire's share. All of the significant capital gains or losses attributable to any of the business entities are aggregated in the realized securities gain figure at the bottom of the table, and are not included in operating earnings. Earnings before income taxes Berkshire share. Net earnings after tax Berkshire share. Blue Chip and Wesco are public companies with reporting requirements of their own. On pages 3743 of this report, we have reproduced the narrative reports of the principal executives of both companies, in which they describe 1,979 operations. Some of the numbers they mention in their reports are not precisely identical to those in the above table because of accounting and tax complexities. The Yanomamo Indians employ only 3 numbers: 1, 2, and more than 2. Maybe their time will come. However, the commentary in those reports should be helpful to you in understanding the underlying economic characteristics and future prospects of the important businesses that they manage. A copy of the full annual report of either company will be mailed to any shareholder of Berkshire upon request to Mr. Robert H. Bird for Blue Chip Stamps, 5801 Southeastern Avenue, Los Angeles, California, 90040, or to Mrs. Beth Deckard for Wesco Financial Corporation, 315 East Colorado Boulevard, Pasadena, California 91,109, Textiles and Retailing. The relative significance of these two areas has diminished somewhat over the years as our insurance business has grown dramatically in size and earnings. Ben Rosner, at Associated Retail Stores, continues to pull rabbits out of the hat, big rabbits from a small hat. Year after year, he produces very large earnings relative to capital employed realized in cash and not in increased receivables and inventories, as in many other retail businesses in a segment of the market with little growth and unexciting demographics. Ben is now 76, and, like our other up-and-comers, Gina Begg, 82, at Illinois National and Louis Vincenti, 74, at Wesco, regularly achieves more each year. Our textile business also continues to produce some cash, but at a low rate compared to capital employed. This is not a reflection on the managers, but rather on the industry in which they operate. In some businesses, a network TV station, for example, it is virtually impossible to avoid earning extraordinary returns on tangible capital employed in the business. And assets in such businesses sell at equally extraordinary prices, 1,000 cents or more on the dollar, a valuation reflecting the splendid, almost unavoidable, economic results obtainable. Despite a fancy price tag, the easy business may be the better route to go. We can speak from experience, having tried the other route. Your chairman made the decision a few years ago to purchase Wambeck Mills in Manchester, New Hampshire, thereby expanding our textile commitment. By any statistical test, the purchase price was an extraordinary bargain. We bought well below the working capital of the business, and in effect, got very substantial amounts of machinery and real estate for less than nothing. But the purchase was a mistake. While we labored mightily, new problems arose as fast as old problems were tamed. Both our operating and investment experience cause us to conclude that turnarounds seldom turn, and that the same energies and talent are much better employed in a good business purchased at a fair price than in a poor business purchased at a bargain price. Although a mistake, the Wambeck acquisition has not been a disaster. Certain portions of the operation are proving to be valuable additions to our Decorator line, our strongest franchise, at New Bedford, and it's possible that we may be able to run profitably on a considerably reduced scale at Manchester. However, our original rationale did not prove out. Insurance underwriting. We predicted last year that the combined underwriting ratio, see definition on page 36, for the insurance industry would move up at least a few points, perhaps enough to throw the industry as a whole into an underwriting loss position. That is just about the way it worked out. The industry underwriting ratio rose in 1979 over 3 points, from roughly 97.4% to 100.7%. We also said that we thought our underwriting performance relative to the industry would improve somewhat in 1979, and again, things worked out as expected. Our own underwriting ratio actually decreased from 98.2% to 97.1%. Our forecast for 1,980 is similar in one respect. Again, we feel that the industry's performance will worsen by at least another few points. However, this year we have no reason to think that our performance relative to the industry will further improve. Don't worry, we won't hold back to try to validate that forecast. Really extraordinary results were turned in by the portion of National Indemnity Company's insurance operation run by Phil Leashe. Aided by Roland Miller in underwriting, and Bill Lyonson claims, this section of the business produced an underwriting profit of $8.4 million on about $82 million of earned premiums. Only a very few companies in the entire industry produced a result comparable to this. You will notice that earned premiums in this segment were down somewhat from those of 1,978. We hear a great many insurance managers talk about being willing to reduce volume in order to underwrite profitably, but we find that very few actually do so. Phil Leashe is an exception. If business makes sense, he writes it; if it doesn't, he rejects it. It is our policy not to lay off people because of the large fluctuations in workload produced by such voluntary volume changes. We would rather have some slack in the organization from time to time than keep everyone terribly busy writing business on which we are going to lose money. Jack Ringwalt, the founder of National Indemnity Company, instilled this underwriting discipline at the inception of the company, and Phil Lisha never has wavered in maintaining it. We believe such strong-mindedness is as rare as it is sound, and absolutely essential to the running of a first-class casualty insurance operation. John Seward continues to make solid progress at Home and Automobile Insurance Company, in large part by significantly expanding the marketing scope of that company in general liabilities. These lines can be dynamite, but the record to date is excellent, and, in John McGowan and Paul Springman, we have two cautious liability managers extending our capabilities. Our reinsurance division, led by George Young, continues to give us reasonably satisfactory overall results after allowing for investment income, but underwriting performance remains unsatisfactory. We think the reinsurance business is a very tough business that is likely to get much tougher. In fact, the influx of capital into the business and the resulting softer price levels for continually increasing exposures may well produce disastrous results for many entrants, of which they may be blissfully unaware until they are in over their heads. Much reinsurance business involves an exceptionally long tail, a characteristic that allows catastrophic current loss experience to fester, undetected for many years. It will be hard for us to be a whole lot smarter than the crowd, and thus our reinsurance activity may decline substantially during the projected prolonged period of extraordinary competition. The Homestate operation was disappointing in 1979. Excellent results again were turned in by George Billings at Texas United Insurance Company, winner of the annual award for the low loss ratio among Homestate companies, and Floyd Taylor at Kansas Fire and Casualty Company. But several of the other operations, particularly Cornhusker Casualty Company, our first and largest Homestate operation and historically a winner, had poor underwriting results which were accentuated by data processing, administrative and personnel problems. We have made some major mistakes in reorganizing our data processing activities, and those mistakes will not be cured immediately or without cost. However, John Ringwalt has thrown himself into the task of getting things straightened out, and we have confidence that he, aided by several strong people who recently have been brought aboard, will succeed. Our performance in workers' compensation was far, far better than we had any right to expect at the beginning of 1979. We had a very favorable climate in California for the achievement of good results, but, beyond this, Milt Thornton at Cypress Insurance Company and Frank DiNardo at National Indemnity's California workers' compensation operation both performed in a simply outstanding manner. We have admitted, and with good reason, some mistakes on the acquisition front, but the Cypress purchase has turned out to be an absolute gem. Milt Thornton, like Phil Lisha, follows the policy of sticking with business that he understands and wants, without giving consideration to the impact on volume. As a result, he has an outstanding book of business and an exceptionally well-functioning group of employees. Frank DiNardo has straightened out the mess he inherited in Los Angeles in a manner far beyond our expectations, producing savings measured in 7 figures. He now can begin to build on a sound base. At year-end, we entered the specialized area of surety reinsurance under the management of Chet Noble. At least initially, this operation will be relatively small, since our policy will be to seek client companies who appreciate the need for a long-term partnership relationship with their reinsurers. We are pleased by the quality of the insurers we have attracted, and hope to add several more of the best primary writers as our financial strength and stability become better known in the surety field. The conventional wisdom is that insurance underwriting overall will be poor in 1980, but that rates will start to firm in a year or so, leading to a turn in the cycle sometime in 1981. We disagree with this view. Present interest rates encourage the obtaining of business at underwriting loss levels formerly regarded as totally unacceptable. Managers decry the folly of underwriting at a loss to obtain investment income, but we believe that many will. Thus we expect that competition will create a new threshold of tolerance for underwriting losses, and that combined ratios will average higher in the future than in the past. To some extent, the day of reckoning has been postponed because of marked reduction in the frequency of auto accidents, probably brought on in major part by changes in driving habits induced by higher gas prices. In our opinion, if the habits hadn't changed, auto insurance rates would have been very little higher, and underwriting results would have been much worse. This dosage of serendipity won't last indefinitely. Our forecast is for an average combined ratio for the industry in the 105 area over the next 5 years. While we have a high degree of confidence that certain of our operations will do considerably better than average, it will be a challenge to us to operate below the industry figure. You can get a lot of surprises in insurance. Nevertheless, we believe that insurance can be a very good business. It tends to magnify, to an unusual degree, human managerial talent or the lack of it. We have a number of managers whose talent is both proven and growing. And, in addition, we have a very large indirect interest in 2 truly outstanding management groups through our investments in Safeco and Geico. Thus we expect to do well in insurance over a period of years. However, the business has the potential for really terrible results in a single specific year. If accident frequency should turn around quickly in the auto field, we, along with others, are likely to experience such a year. Insurance investments. In recent years we have written at length in this section about our insurance equity investments. In 1979 they continued to perform well, largely because the underlying companies in which we have invested, in practically all cases, turned in outstanding performances. Retained earnings applicable to our insurance equity investments, not reported in our financial statements, continue to mount annually and, in aggregate, now come to a very substantial number. We have faith that the managements of these companies will utilize those retained earnings effectively and will translate a dollar retained by them into a dollar or more of subsequent market value for us. In part, our unrealized gains reflect this process. Below we show the equity investments which had a year-end market value of over $5 million. We currently believe that equity markets in 1980 are likely to evolve in a manner that will result in an underperformance by our portfolio for the first time in recent years. We very much like the companies in which we have major investments, and plan no changes to try to attune ourselves to the markets of a specific year. Since we have covered our philosophy regarding equities extensively in recent annual reports, a more extended discussion of bond investments may be appropriate for this one, particularly in light of what has happened since year-end. An extraordinary amount of money has been lost by the insurance industry in the bond area, notwithstanding the accounting convention that allows insurance companies to carry their bond investments at amortized cost, regardless of impaired market value. Actually, that very accounting convention may have contributed in a major way to the losses. Had management been forced to recognize market values, its attention might have been focused much earlier on the dangers of a very long-term bond contract. Ironically, many insurance companies have decided that a 1-year auto policy is inappropriate during a time of inflation, and 6-month policies have been brought in as replacements. How, say many of the insurance managers, can we be expected to look forward 12 months and estimate such imponderables as hospital costs, auto parts prices, etc.? But, having decided that a year is too long a period for which to set a fixed price for insurance in an inflationary world, they then have turned around, taken the proceeds from the sale of that 6-month policy, and sold the money at a fixed price for 30 or 40 years. The very long-term bond contract has been the last major fixed-price contract of extended duration still regularly initiated in an inflation-ridden world. The buyer of money to be used between 1980 and 2020 has been able to obtain a firm price now for each year of its use, while the buyer of auto insurance, medical services, newsprint, office space, just about any other product or service would be greeted with laughter if he were to request a firm price now to apply through 1985. For in virtually all other areas of commerce, parties to long-term contracts know either index prices in some manner or insist on the right to review the situation every year or so. A cultural lag has prevailed in the bond area. The buyers, borrowers, and middlemen, underwriters, of money hardly could be expected to raise the question of whether it all made sense, and the sellers' lenders slept through an economic and contractual revolution. For the last few years our insurance companies have not been a net purchaser of any straight long-term bonds, those without conversion rights or other attributes offering profit possibilities. There have been some purchases in the straight bond area, of course, but they have been offset by sales or maturities. Even prior to this period, we never would buy 30 or 40-year bonds. Instead, we tried to concentrate in the straight bond area on shorter issues, with sinking funds and in issues that seemed relatively undervalued because of bond market inefficiencies. However, the mild degree of caution that we exercised was an improper response to the world unfolding about us. You do not adequately protect yourself by being half awake while others are sleeping. It was a mistake to buy 15-year bonds, and yet we did, we made an even more serious mistake in not selling them, at losses if necessary, when our present views began to crystallize. Naturally, those views are much clearer and definite in retrospect. It would be fair for you to ask why we weren't writing about this subject last year. Of course, we must hold significant amounts of bonds or other fixed dollar obligations in conjunction with our insurance operations. In the last several years, our net fixed dollar commitments have been limited to the purchase of convertible bonds. We believe that the conversion options obtained, in effect, give that portion of the bond portfolio a far shorter average life than implied by the maturity terms of the issues. That is to say, at an appropriate time of our choosing, we can terminate the bond contract by conversion into stock. This bond policy has given us significantly lower unrealized losses than those experienced by the great majority of property and casualty insurance companies. We also have been helped by our strong preference for equities in recent years that has kept our overall bond segment relatively low. Nevertheless, we are taking our lumps in bonds and feel that, in a sense, our mistakes should be viewed less charitably than the mistakes of those who went about their business unmindful of the developing problems. Harking back to our textile experience, we should have realized the futility of trying to be very clever via sinking funds and other special type issues in an area where the tide was running heavily against us. We have severe doubts as to whether a very long-term fixed interest bond, denominated in dollars, remains an appropriate business contract in a world where the value of dollars seems almost certain to shrink by the day. Those dollars, as well as paper creations of other governments, simply may have too many structural weaknesses to appropriately serve as a unit of long-term commercial reference. If so, really long bonds may turn out to be obsolete instruments, and insurers who have bought those maturities of 2010 or 2020 could have major and continuing problems on their hands. We, likewise, will be unhappy with our 15-year bonds and will annually pay a price in terms of earning power that reflects that mistake. Some of our convertible bonds appear exceptionally attractive to us and have the same sort of earnings retention factor, applicable to the stock into which they may be converted, that prevails in our conventional equity portfolio. We expect to make money in these bonds. We already have, in a few cases, and have hopes that our profits in this area may offset losses in straight bonds. And, of course, there is the possibility that our present analysis is much too negative. The chances for very low rates of inflation are not nil. Inflation is man-made, perhaps it can be man-mastered. The threat which alarms us may also alarm legislators and other powerful groups, prompting some appropriate response. Furthermore, present interest rates incorporate much higher inflation projections than those of a year or two ago. Such rates may prove adequate or more than adequate to protect bond buyers. We even may miss large profits from a major rebound in bond prices. However, our unwillingness to fix a price now for a pound of See's candy or a yard of Berkshire cloth to be delivered in 2010 or 2020 makes us equally unwilling to buy bonds which set a price on money now for use in those years. Overall, we opt for Polonius, slightly restated, neither a short-term borrower nor a long-term lender b. Banking. This will be the last year that we can report on the Illinois National Bank and Trust Company as a subsidiary of Berkshire Hathaway. Therefore, it is particularly pleasant to report that, under Gina Beggs and Pete Jeffries' management, the bank broke all previous records and earned approximately 2.3% on average assets last year, a level again over 3 times that achieved by the average major bank, and more than double that of banks regarded as outstanding. The record is simply extraordinary, and the shareholders of Berkshire Hathaway owe a standing ovation to Gina Begg for the performance this year and every year since our purchase in 1969. As you know, the Bank Holding Company Act of 1969 requires that we divest the bank by December 31, 1980. For some years we have expected to comply by effecting a spin-off during 1980. However, the Federal Reserve Board has taken the firm position that if the bank is spun off, no officer or director of Berkshire Hathaway can be an officer or director of the spun-off bank or bank holding company, even in a case such as ours in which one individual would own over 40% of both companies. Under these conditions, we are investigating the possible sale of between 80% and 100% of the stock of the bank. We will be most choosy about any purchaser, and our selection will not be based solely on price. The bank and its management have treated us exceptionally well, and if we have to sell, we want to be sure that they are treated equally as well. A spin-off still is a possibility if a fair price along with a proper purchaser cannot be obtained by early fall. However, you should be aware that we do not expect to be able to fully, or even in very large part, replace the earning power represented by the bank from the proceeds of the sale of the bank. You simply can't buy high-quality businesses at the sort of price, earnings multiple likely to prevail on a bank sale. Financial reporting. During 1979, Nasdaq trading was initiated in the stock of Berkshire Hathaway. This means that the stock now is quoted on the over-the-counter page of the Wall Street Journal under additional OTC quotes. Prior to such listing, the Wall Street Journal and the Dow Jones news ticker would not report our earnings, even though such earnings were 100 or more times the level of some companies whose reports they regularly picked up. Now, however, the Dow Jones news ticker reports our quarterly earnings promptly after we release them, and in addition, both the ticker and the Wall Street Journal report our annual earnings. This solves a dissemination problem that had bothered us. In some ways, our shareholder group is a rather unusual one, and this affects our manner of reporting to you. For example, at the end of each year, about 98% of the shares outstanding are held by people who also were shareholders at the beginning of the year. Therefore, in our annual